You just paid off your loan. So why did your credit score drop? Because three parts of the system just moved against you.
And one simple move after paying off debt
can quietly damage your score for months.
You just made the final payment on a loan.
You are debt-free. You check your credit score, expecting a victory lap. Instead, it dropped. Sometimes by 10 points, sometimes by 40 or more. If this has happened to you, you are not alone. And no, you did not do anything wrong. The credit scoring system has a quirk that punishes people for doing exactly what they are supposed to do, paying off their debts. This is the story of why your credit score drops when you finally become debt-free, how the system actually works, and, most importantly, what you can do to protect your score while still achieving your financial goals. Stay until the end, because we are revealing the single biggest mistake people make after paying off a loan that can tank their score for months, and exactly what to do instead. Your credit score is calculated based on 5 main factors. Payment history accounts for 35%. Amounts owed, which is your credit utilization ratio, accounts for 30%. Length of credit history accounts for 15%. Credit mix accounts for 10%. And new credit inquiries account for the final 10%. When you pay off a loan, 3 of these 5 factors can shift against you. And that is why your score drops. Here is what happens. Let us say you have a credit card you have held for 10 years and a personal loan you have held for 5 years. Your average account age is 7.5 years. You pay off the personal loan and close it. Now your only open account is the credit card at 10 years. Your average age actually went up, so no problem. But if that personal loan was your oldest account, the situation flips. Let us say you have a credit card you have held for 2 years and a personal loan you have held for 8 years. Your average account age is 5 years. You pay off the personal loan and close it. Now your only open account is the 2-year-old credit card. Your average account age drops from 5 years to 2 years. That drop can cause your score to dip. Equifax, one of the 3 major credit bureaus, notes that closed accounts in good standing can remain on your credit report for up to 10 years, but they do not continue to age once closed. So over time, as they fall off, the impact on your average age diminishes. This is the factor that surprises most people because it is not obvious. Credit utilization is the amount of revolving credit you are using divided by your total available credit. It accounts for 30% of your score. Here is how paying off a loan can accidentally hurt your utilization. Let us say you have 3 credit cards with a total credit limit of $10,000. You have a balance of $3,000 across those cards. Your credit utilization is 30%. That is the threshold experts recommend staying under. Now, you decide to pay off a personal loan. In the process, you also close 2 of your credit cards because you want to simplify your finances. Those 2 cards had a combined credit limit of $8,000. You keep 1 card open with a limit of $2,000. But you still have that $3,000 balance. Your utilization just jumped from 30% to 150%. You are now maxed out on your only remaining card. Your credit score will drop significantly. This is why financial experts warn against closing credit cards after paying them off, especially if you have balances on other cards. The available credit disappears and your utilization ratio spikes. So, what kind of drop are we talking about? For most people with decent credit, the dip after paying off a loan is small and temporary. Expect somewhere in the range of 5 to 10 points if you already have good credit. But if you make the mistake of closing multiple credit cards at the same time, or if the loan you paid off was your only active account, the drop can be much larger. Some borrowers have reported drops of 40 to 60 points after paying off a loan and closing cards simultaneously. The good news is that these drops do not last. According to Equifax, if your score dips after paying off a loan, you can expect to see it rebound about 30 to 45 days after the payoff, assuming all your other accounts remain in good standing. There is another factor at play that has nothing to do with the scoring formula. Credit bureaus do not update in real time. Lenders typically report to the bureaus once a month on a billing cycle. It can take 30 to 45 days for your paid-off loan to show as closed on your credit report. If you check your score the day after making your final payment and see no change, or worse, a drop, it may simply be that the update has not happened yet. The system is still showing your old balance. Be patient. So what should you do instead? If you have a loan coming due, or if you are planning to pay one off early, there are specific steps you can take to protect your score. First, do not close old credit cards when you pay them off. Keep them open, especially if they are among your oldest accounts. Use them for a small purchase every few months to keep them active and pay the balance in full. This preserves your available credit and your credit history length. Second, if you are paying off your only installment loan, consider whether you need to apply for new credit in the next few months. If you were planning to buy a house or a car, the temporary dip from paying off a loan could affect your interest rate. In that case, timing matters. You may want to pay off the loan after securing the new credit, not before. Third, keep your credit utilization low. The ideal is under 30% across all cards. Even better is under 10%. Fourth, set up automatic payments on all remaining accounts. Payment history is 35% of your score. One missed payment can do more damage than any loan payoff dip. Fifth, check your credit report about 30 to 60 days after paying off the loan. Make sure the account is marked as closed with a zero balance. If it still shows as open or active, contact the lender and dispute the error with the credit bureau. Mistakes happen. A temporary dip after paying off a loan is not a sign of failure. It is a quirk in the scoring algorithm. The long-term benefit of being debt-free far outweighs a short-term drop of a few points. Your payment history on that closed loan stays on your credit report for up to 10 years if it was in good standing. That positive history continues to work in your favor. Lenders can see that you took out a loan and paid it back exactly as agreed. The bottom line is that your credit score is a tool. It is not a measure of your worth as a person. It is a measure of how well you manage credit according to a specific formula. That formula rewards you for having a mix of credit types, for keeping accounts open for a long time, and for using only a small portion of your available credit. When you pay off a loan, you lose some of that mix. You may shorten your average account age, and if you close credit cards, you lose available credit. But none of that changes the fundamental truth. Paying off debt is a good thing. It improves your financial health, reduces stress, and puts you in control of your money. If your score drops after paying off a loan, wait 45 days. Keep making on-time payments on your remaining accounts. Keep your credit card balances low, and watch your score recover. The system is designed to reward consistent responsibility over time, not one-time events. So go ahead and make that final payment. Celebrate being debt-free, and do not let a temporary dip convince you that you made a mistake. You did not. If you made it to the end, you now know why your credit score drops when you do the right thing. Hit that like button if you have ever been surprised by a score drop after paying off debt. Subscribe for more straight answers about personal finance. And share this with someone who needs to hear that paying off their loan was still the right move. Thanks for watching.
You just paid off your loan.
So why did your credit score drop? Because 3 parts of the system just moved against you.
And one simple move after paying off debt
can quietly damage your score for months.